play really big, whether it's direct lending, it's high yield, it's leveraged loans, CLOs. What do you see? What do you think in the market right now?
So you are still getting paid 8 to 9% for first lien floating rate risk to large corporate borrowers. We're talking about borrowers with $850 million EBITDA on average. So I actually think you can get good value in the liquid credit markets. What we're seeing in the fundamental performance, and think about our market, most of these are private borrowers. You don't have access to that information, but we lend to over 600 US companies, over 200 in Europe. So we have some differentiated data that we could take a look at. And I could tell you that we're seeing the highest percent of our companies grow EBITDA than we've seen in 2 years. So since Ukraine, when things started to change, EBITDA is growing faster than sales. We're seeing companies focus on free cash flow. And why is that? Because rates are higher, and they've accepted that they're going to live in this higher for longer rate environment. So we're seeing record numbers of our companies produce free cash flow even in the higher rate environment.
What about actual sales? Like, do we care about sales? Like, are we gonna, like, is that a worry, or is it just, okay, they're growing their EBITDA, it's all right?
You care about sales if you're going, if they're telling you you're going into a recession, but sales are slowing, and that's true. So we're seeing a slower pace of sales growth and your EBITDA growth, but that makes sense to me because companies are focused on profitability and cash flow.
Well, let's talk about defaults for a second here, because there's been a lot of discussion here about why we didn't see higher default rates, whether that was kind of a head fake, or and whether that's kind of still kind of the boogie monster out there. Are we kind of past that point where we should be assessing over default rates?
I think so, unless we really go into a deep recession. So default rates, there were all sorts of very high projections out there. We're at 1% as a market. That's much lower than long-term averages, which are between 2 and 3%, depending on the time frame you're looking at. I think the loan market is very bifurcated, though. So you could have, you see most of our companies that trade around par, meaning there's not really problems in those credits. And then you have about 4% of the market that trades under 80. And I'd watch that for more signs of stress. But again, that's the lowest it's been in 2 years. It has come down since Ukraine.
So when we talk about the favorability in terms of pricing, and obviously with the spreads that we see in the secondary market here, are we going to see that also improve, given that it felt like everyone was pricing in gloom and doom, I don't know, maybe like a year ago, and obviously that didn't materialize?
Yeah, so there's a lot of refinancings in our market, which means spreads are coming down. Performing credit is going to be able to access credit cheaper.
What about banks reporting on Friday, right? We're all going to be looking for that investment banking revenue. Like, we know the fees and underwriting and all that, but it's about M&A, right? Is it going to come back? Are the banks going to make money from it? And does that mean we're going to see a lot more leveraged loans and a lot more borrowers in the market to pay for all the M&A? Is that going to happen?
So there's a lot of leveraged loan activity, but it's mostly refinancing. So net volumes are not up. As far as M&A, there should be an increase this year. We're starting to see trickles of that in the leveraged loan market. There's stability in the market. Financing markets are wide open. So if you want to acquire a company and use loans to back it, it's available to you. That said, rates are high, right? The all-in cost of debt is high. So I don't think you go back to an environment like 2021 where you had record M&A, but we should be busier with M&A than we were last year.
If you see the Fed cut like 50 basis points, 75 basis points, does that change? How does that change the landscape then?
I don't think 50 basis points makes the big difference. I think it's the expectation for continued cuts. When you're running your models and you're thinking that your cost of interest is going to continue to come down, I think that's the difference.
I do want to talk about this idea of portfolio allocation. And there was a lot of discussion over the last years about how some of the institutional interests had maybe tapped out or at least reached an allocation level. They were bumping up against their own internal limits. And there was a much more of a focus on moving out to wealth management, the high net worth individuals. Are you seeing more appetite coming from the retail side relative to maybe what we saw on the institutional side a few years ago?
Yeah, I'd say two things. One, CLOs are returning cash. So it's an asset class where there's actually still demand because they're getting back their money. And two, we've seen a record year of retail demand for CLO product and floating rate product, which makes sense because rates are higher and you're getting a floating rate product. I think it's the first time we've really seen some democratization of institutional product in the CLO market finally being offered to retail investors. Are
you worried at all about the regulatory environment around that? Of course, as more retail investors get involved, not just in CLOs and some of the other areas of alternative investments, folks in Washington start to get a little antsy and they say, okay, is this too risky for those types of folks?
What's great about CLOs is they have a 25-year track record and they performed as advertised through every cycle.
So, but to that point, you know, there was an article on the Bloomberg terminal that also talked about double Bs right now and how there are tons of tourists now in the market. And if the liquidity dries up, the tourists are going to get like caught with their pants down. The article didn't say that. This was just me like encapsulating the idea. Would it be the same for CLOs? Like, are the retail guys tourists, and is that kind of a risk if liquidity does dry up?
You could certainly see outflows. I think some of the biggest inflows have been into AAA product, which is a very, very stable product. So if you saw a lot of outflows, could that get a little more volatile? Yes, but I think the institutional demand will be there to buy the paper.
So I'm asking for a friend. If I have money in a money market fund yielding 5%, I don't know what to do with it. What should I do with it?
So
it's a friend. It's not me. It's a friend.
We're seeing value really across the liquid space right now. I would talk about CLO double Bs. CLO double Bs today are paying about 12% current income. If you compare that to something like high yield, which is closer to 8%, it would have a better total return, a better current coupon, better Sharpe ratio. I think there's good relative value there. And then I look at CLO equity, and we're seeing some of the highest cash distributions than we have since 2015, which also seems like a compelling opportunity.